This is the Phelan and Myers 2 for 20 with the Willett, Phelan, Myers & Rotz Wealth Management Group of Janney Montgomery Scott. Janney, a member of FINRA, SIPC, and the New York Stock Exchange, maintains a presence in Duluth with their office at 6340 Sugarloaf Parkway, Suite 130, Duluth, Georgia.
Good morning and welcome to Phelan and Myers 2 for 20. We have a year-end tax planning podcast this month. We've got a CPA, a tax attorney, and the managing partner from Warren Averett with us. Her name is Kim Hartsock. So welcome, Kim. Do you want to introduce the folks that you brought with you today to help us do some year-end tax planning?
Sure. Thanks, Scott. Thanks for having us.
Absolutely.
I brought the experts in if you want to do some year-end planning from a tax perspective. So we're lucky to have with us Alexander Larson and Chris Wiginton, and they are both experts in this field and will be able to give your listeners what they need to know as they head into the year-end and start planning for their tax returns.
Perfect. So let's talk about how do we save some money first on income taxes, hopefully, and potentially capital gains. So we'll start with you, Alexander, and then we will talk about the estate tax here in a few minutes, Chris. So, Alexander, let's start kind of with the most basic tax planning as we go into year-end. Capital gains and losses. How can we use potential losses and investments to offset some capital gains that we might have?
Right. So, excellent question. Basically, any asset that you hold for investment purposes is treated as a capital asset, right? So gains and losses on the disposal of those assets usually recognized in your income. And the first question you really need to answer is how long did you have the asset for?
Okay.
So if you hold an asset for longer than a year and 1 day, it's treated as long-term. Everything else is going to be treated as short-term. It's very basic. Now, long-term capital gains per se, they also fall into different buckets depending on what type of an asset it is.
Okay.
Say, for example, listeners who are investing, say, in gold or ETFs backed by gold, precious metals and whatnot, those collectibles are generally taxed at 28%. If you sell real estate, investment real estate, and a portion of that gain represents depreciation taken in the prior years, it's generally recaptured. We call it a recapture 25%. Everything else, stocks, bonds, securities, capital assets are either taxed at 0, 15, or 20% depending on your total income. So recognizing gains and losses for the year, there is a complicated netting mechanism in place that eventually gets you to a point where you either have a net gain or a loss position for the year. And so depending on which bucket your gains fell in, like I mentioned before, you would tax them at an appropriate rate. Now, if you have a loss position, this is the tricky part, right? And then the podcast kind of a theme. You can only offset your ordinary income to the extent you have any from your W-2 wages or self-employment, maybe some partnership income, up to $3,000.
Okay.
And then that loss is carried forward. You cannot deduct more than that against your ordinary income.
Okay, so if we use an example, let's say I buy a piece of real estate. I'm lucky I pay, I don't know, pick a number, $100,000 for
Sure.
it, and I own it for 6 months, okay, and I sell it for $150,000.
Right.
I've got a $50,000 capital gain.
Correct.
You're saying because I owned it for less than a year and a day, that $50,000 gain is taxed as ordinary income.
Ordinary income at your ordinary rates, whatever it is, correct.
Okay, and had I held it for a year and a day or longer, that'd be taxed as capital gain, and that capital gain rate is going to be dependent upon what my overall income is for the year.
Exactly. That is correct. And there's one piece also I just wanted to mention, it's kind of new and not a lot of people actually keep track of it, is that if you're kind of edging, or become a higher net worth individual from the net investment income tax standpoint, you may owe an additional 3.8% on these kinds of capital gains as well. So you need to factor it into your tax planning, year-end tax planning, because you will have to pay that additional tax on it as well. It's a pretty complicated formula. Readers can look this up, read up, things on the net investment income tax, but definitely keep that in mind.
Okay. So going back to that example, I had a $50,000 short-term or long-term capital gain depending on my holding period.
Correct.
Now, if I had a loss in a stock, for example, let's say I bought a stock and I had a $20,000 loss in it. I can use that loss, correct me if I'm wrong, against that $50,000 gain.
Correct.
So $50,000 gain, $20,000 loss, I have a net $30,000 gain, correct? Okay. So this time of year, we want to start looking for some tax losses maybe in some of the investments that we've got.
Correct. No,
fair
totally.
statement?
Absolutely. And then with stocks, just talking about losses and kind of mentioning this piece of it as well. So if you have stocks or securities, and the definition here is really important, and you, for example, sell a stock or, a security, and then you replace it within 30 days, or you purchased an identical security prior to selling it within 30 days, it's called a wash sale loss, okay? Wash sale losses are not allowed. They're deferred. So what happens with that particular loss, in your example, let's pretend that $20,000 was a wash sale loss. You cannot offset the gain that you just realized on the sale of that property. Okay. You will add it to the basis of what your new stock is, and then you're going to carry it forward until the day you sell it.
So you just need to be careful when you accumulate some of those losses going into the end of the year.
Precisely.
That you're waiting at least 30 days if you want to buy the stock back, which you can do. You can buy it back after 30 days, get to keep the loss, and you don't buy a similar stock. So, for example, if you sold Wells Fargo for a loss, you couldn't necessarily turn around and buy Bank of America in lieu of that Wells Fargo and keep it as a loss.
Correct. Yeah, they have to be substantially identical, and usually what we do in the trade is we go by the QSIP. So you look it up. You want to see, exactly if they're identical or not. Obviously, Wells Fargo and Bank of America, they are not identical, right? So the wash sale.
So you could do that in that example. Okay,
correct.
I got you.
Can I just also mention one more thing about wash sale losses? And this is going to be very important from the tax planning standpoint. A lot of investors and individuals, they look at their Form 1099, right? And they say, okay, my wash sales have already been calculated. I don't need to even worry about this or think about this. Now, the wash sale reporting by broker dealers was instituted, I want to say like roughly 10 years ago. And broker dealers, they're not in the business of doing your tax planning for you. The reason I'm saying this is the wash sale amount on your 1099 may be incorrect. And you need to be very transparent and forthcoming with your tax advisor and let them know, especially for the transactions that occurred between December 2nd and January 30th of the following year. And then if you buy and sell Wells Fargo multiple times a year, your wash sale number in your 1099 is likely incorrect. So can you depart from the 1099 reporting? The answer is yes. If it's incorrect, you certainly should report correct amounts, for your gains and loss reporting purposes. But you have to be very careful and then just analyze your 1099. Do not just assume that the wash sale loss amount and the deferral that's reported on it is accurate. Chances are it's not.
Because some of that wash sale information could show up on the following year's 1099.
Precisely.
Okay.
Yep.
Okay, and then so again, going back to that example, let's say we did not sell anything for a gain, right? We had a $20,000 loss for the year. What do you do with that if you have no gains to use against those losses? How does that work?
Right. So you're going to take a look at your ordinary income. If you have enough, we're talking about $3,000 in this case to offset it. So in this case, you're going to have a $17,000 capital loss carry forward. Now, when you carry them forward, you have to be very careful about their character. If they were short-term or long-term, you have to make sure you keep track of that because you don't want to lose it next year because you're going to be going through the netting process yet again. And so depending on how long the net position was that generated that particular loss, you want to make sure you do the right netting next year. So not only do you need to keep track of the amount, but also the character of the carry forward. Now, they're carried forward indefinitely, so obviously, but $3,000, it's a very, very slow clip,
right,
to offset against your ordinary income, right?
So if you have no gains, then it's $3,000
against
basically ordinary income, and you could use that indefinitely.
Correct.
And it's been that way, I think, since the late 70s, if I'm not mistaken, which it's never been indexed up for inflation. It seems like a pretty nominal amount.
Right. Yeah. This is an easy kind of an online check. I haven't looked in a while, but I'm kind of thinking that it was probably even before the Reagan, tax reform. I think you're right about that. Yeah.
Okay. So then if we move forward to IRA withdrawals, there's there's a little bit, 72 to age 73 required minimum distributions used to be at age 70 and a half, and then they've kind of been ratcheting up to where they're currently at age 73.
Right.
And I think, correct me if I'm wrong, I think that's going to ratchet up to age 74, and then
it's going to go up eventually, right? And we have an unusual year this year, right? This is perfect. So what is a required minimum distribution, just to let the listeners know, right? So you have an IRA account, you set the funds aside during your lifetime, you're being very diligent about saving for retirement. That's great. Now, Congress did not really want people to save money and then leave it, and then Chris is going to talk about estate tax planning in a minute, to the future generations without taking a penny out of their savings. So the required minimum distribution regime was introduced. And the way it works is that when you reach a certain age, that year you should start taking these required minimum distributions. The way they're calculated is actually a very simple way of doing this. You look at every single IRA account that you have. You can have multiple, you left your employers, you can have a self-directed IRA, whatever that is. You look at the balance in that account on December 31st of the previous year. Mm-hmm. And then you consult a publication 590B. It's published by the IRS. There are certain tables in that publication that you can take a look at and determine what ratio, what percentage of that balance as of December 31st of the previous year you must take this year to avoid an excise tax. If you do not take a required minimum distribution when you have to take it, current tax is 50%. It's been just scaled down and lowered to 25% by Secure 2.0. And I think it's even going to go further down to 10% depending on how quickly you remedy this mishap. And so, like you mentioned, absolutely right. It used to be 70 and a half. Now the new rule is that if you're turning 73 in 2023, you should start taking those required minimum distributions now. Now, you can defer your very first RMD up to April 1st of the following year. Now, if you do that deferral, what happens is that you technically are going to get taxed twice in the following year. One of them is going to be the RMD for the previous year, and the other one is going to be the RMD for that particular year, right? So from the tax planning standpoint, it's very important for the listeners to consider what their tax bracket is going to be. And if they are just on the cusp of recognizing this income, maybe this year their rate is pretty high. Next year, their rate is going to go down significantly, so it may make sense for them to defer and take that RMD for this year and next year, and then do it all.
So, for example, if I'm terminating work and my income is going to go down significantly next year, that first RMD, it may make sense to do that first year's RMD before April 1 of the following year.
Correct.
And then do my RMD for that year at some point during the year as well.
Correct. You have to do it by
presumably be in a lower tax
by
rate.
December 31st. And that's a very good point. By the way, if you have a 401k plan, you're still working, you're still employed, the current law says that you do not need to take required minimum distributions out of that plan while you're still employed. The day you retire, and if you are in the the age 73 and above, you have to start taking the RMDs. Now, I did mention that this particular year has been very interesting, right, for us. So for the listeners who are in this age category, right, so we're talking 72 and 73, if you turned 72 last year, meaning 2022, your RMD has already started. You should have taken the first one by April of this year, and then by December 31st, you should pick up your 22 RMD in 23. If you turned 72 in 2023, current year right now, we're still in 23, then your RMD will need to be taken by April 1st of 2025. Okay? Because we're increasing that age from 72 to 73, it's creating this kind of a wrinkle. So, for some people who turned 72 last year, it's unfortunate. Yeah. For people who are turning 72 this year, it's actually good news because they can still get a 1-year deferral on that and take a benefit from that. Yeah.
Okay. So while we're talking about IRAs,
yes,
let's jump forward to charitable tax planning.
Yes.
Because I think IRAs are a great place to do it. So during your life, what can you do in terms of charitable planning as it relates to IRAs?
Yeah, so we can definitely touch base on, estate tax planning and gifting, for that related, to your IRA while you haven't reached a certain age. But once you reach 70 and a half, right, that year, the moment you've turned 70 and a half, you can actually use a portion of your IRA distributions, designate them as a qualified charitable distribution, right? So you can pick up the phone, give a call to your trustee and let them know. And that qualified charitable distribution can go to any 501c3. It must be a publicly supported charity, up to $100,000. And it counts towards your RMD limit. So if you've consulted the publication, you know what your RMD amount is. If you're giving more, you're charitably inclined, that's fabulous. That's really great. If it's a little bit less, then it's going to reduce, obviously, the taxable portion to you. Your trustee will do the transfer. Mm-hmm. They will do that for you. They will report the gross distribution on the 1099-R. And the beauty of the reporting for an individual is that it does not increase your adjusted gross income. Mm-hmm. So for individuals for whom that adjusted gross income amount is important, especially for Social Security, Medicare, Medicaid benefits, it is crucial, to keep that in mind. It does not go to your Schedule A on your taxes. It actually is a reduction. So on your line 4B on the front page of your 1040, you're just going to write QCD for qualified charitable donation, and it's not going to factor into your AGI. But that mechanism and that reporting is done by consulting and touching base with your trustee. Now, one point about the trustee, I mentioned 1099s with respect to wash sale reporting. Be careful about 1099Rs as well. There is no current mechanism for reporting these qualified charitable donations on the 1099R. Your financial institution may be very helpful, and they can include an additional page with white page disclosures, or add a line. But you need to let your tax professional know, because what may happen is they may accidentally pick it up as a gross distribution in your income and tax you on the full amount without knowing that a portion of it or all of it went to a charity. So be careful about those qualified charitable distributions and how they're being reported on your taxes. So that's a very good tax planning idea for year end.
So the takeaway on that is make sure your CPA knows, hey, of this $30,000 distribution, 10 went to charity, 20 came to me.
Correct.
So you get the tax benefit for that 10 that went to charity.
Precisely.
Right? And then in terms of the dollar amount that goes to charity, so your required distribution starts at 73 currently.
Correct.
But what you're saying is that you can give up to $100,000 starting at age 70 and a half.
Correct.
Out of your IRA and keeping it off your tax return.
That's right.
Okay, perfect. Thank you, Alexander. So let's move over to Chris and talk a little bit about estate tax planning. So thank you for being here.
Thanks for having me.
Absolutely. So, I've done some talks over the years on estate tax planning. The way I always started is there's three things that the IRS gives you as it relates to estate tax planning that you can do to mitigate that potential estate tax liability. Can you talk about those? Let's maybe start with the most basics of those three, the unlimited marital deduction.
Sure, yeah. And so the marital deduction is in place so that spouses can transfer property, no matter what the amount is, back and forth between the two of them. And that's whether it's during lifetime or at death. We'll talk some in a minute about the unified credit, and the reason it's called unified is because our transfer tax system is set up in such a way that it's this total of lifetime gifts versus transfers at death. So yeah, regardless of whether it's during your life or not, you can transfer as much as you want to your spouse.
Okay. So, and what is your spouse's name, Chris?
Joy.
Joy. Okay. So you pass away, you can give everything to Joy 100% estate tax free and vice versa.
That's correct. Yes.
Accurate statement. Okay.
Yes.
And then the gift tax exclusion. Can you talk a little bit about that? So if you and Joy wanted to start gifting some money to your 4 children, how does that work? And then I get a lot of questions about the gift tax. What is this gift tax? Is it an actual tax? How does it work? What do I do? I get tons of questions on that.
Sure.
And it's kind of a misnomer, really.
It really kind of is. Because again, you've got this unified credit amount, which this year was $12,920,000 per person. That's going to go up next year to $13,610,000 because unlike the $3,000 that Alexander talked about earlier, this is indexed for inflation. So there is a bump each year based on inflation, but there's also the annual exclusion for gifting as well. So again, if my wife and I wanted to start gifting to our kids, we could gift an amount up to $17,000 per child per year. And it's not just children. You could gift it to anyone, to other relatives, to friends, whomever. And that doesn't reduce your unified credit. So if we were to give $17,000 to each of our kids this year, our unified credit amount is still going to be the $12,920,000 amount. There are some exceptions to that too, above and beyond being able to give that $17,000. You can pay tuition directly to an educational institution. So my older two kids are in graduate school right now, so any amounts that we pay in terms of their tuition, that doesn't count towards that $17,000. Same thing goes with medical expenses. But in both of those instances, whoever is making the gift to pay those expenses needs to pay them directly to either the educational institution or the medical provider, because if you pay it to your child and then they turn around and pay it, it counts against the $17,000.
Okay, so you enjoy $17,000 apiece, $34,000. You've got 4 children. You can give $34,000 to each of them. If they had spouses, you give $34,000 to the spouse. Children, if
Correct.
Their children, your grandchildren, $34,000, no tax. Now, what if one of your kids, instead of being able to give $34,000, you gave them $40,000? So you exceeded that $34,000 by $6,000, obviously. What is this thing called gift tax? How does that work?
Well, it creates this requirement where you have to file a gift tax return to show. So my total gifts in this case would be the $40,000 to the one child plus $34,000 to each of the other kids. So you would show those total gifts on your return. You would show the annual exclusion that counts that you can credit towards those gifts, and then anything above that is going to reduce that unified credit amount. Because again, that unified credit, you look at it as it's kind of this declining balance that you have over your lifetime to make gifts, to make transfers to others. And so, yeah, it's just going to, that any excess over that annual exclusion amount is just going to decrease that unified credit amount.
That $12,920,000.
Correct.
Okay, so between you and Joy collectively, $12,920,000 apiece, you can effectively give $26 million estate tax free to the next generation.
Correct.
Okay, so in this example, you exceeded the $12 million or the $34,000 gifting limits by $6,000. So that $6,000 would come off of your $12,920,000. So now, instead of $12,920,000, you can give $12,914,000 upon your debt. Okay.
Yes.
Okay. So the unified credit. So back in the day, years ago, spouses would set up their estate where they'd have half their net worth in each of their names. They'd set up, what's called a marital trust in their wills. So if one of them passed away, it would go into this trust, and that would be excluded from estate taxes. But in 2010, right? Was it 2010?
It was 2012.
2012.
Yeah.
Okay, that changed. So 11 years ago, that changed, and it's completely different now. Can you talk about that portability of this $12.9 million and how that works?
Yeah, and as you alluded to, you used to have to equalize assets, and you were taking advantage of the marital deduction because a lot of times you'd have one spouse that had the majority of the assets that weren't held jointly, and so you'd try and equalize everything. But yeah, now we can port that unused exemption. So if you've got all the assets in the name of one spouse and the other spouse passes away first, you're not using any credit at the first spouse's death, but you still have to file a Form 706, the estate tax return, just like you would if it were a taxable estate, and you would elect portability on that return so that the $12,920,000 would go to the surviving spouse to be combined with his or her unified credit, and then once that spouse passes away, the surviving spouse passes away, they would be able to use both credits to shelter those
Now,
assets.
is that just on jointly owned property?
No, it's not. It's on anything. So
It is.
yes.
Okay. So even if I passed away and I've got, let's say my spouse and I have a $26 million estate, just coincidentally enough, $13 million's in my name, $13 million's in her name. I pass away. So when I file that 706, I'm not putting on there, hey, I've got $13 million in my name. I'm just essentially saying my $13 million goes to my spouse. She's now got effectively $26 million upon her death.
That's right. Yes.
Okay.
Yes.
Okay. Interesting. Now, that number, that 13 million or 12,920,000, I'm rounding up here.
Sure.
That is basically getting cut in half. What, January 1 of 2026?
That is correct. So when the current act, the 2017 act was enacted, it basically doubled the unified credit at that point in time. So it went from 5.6 million or whatever it was to 11.2 million, I believe it was. And of course, it's gone up, been adjusted upwards for inflation since then. But of course, like a lot of tax acts, it sunsets as of a particular date. So at the end of December of 2025, that act sunsets, and we go back to the prior amounts, again, still adjusted for inflation. But yes, the long and short of it is that it essentially cuts it in half unless there's new legislation that's enacted before that sunset date. But as of right now, nothing has been done to extend that act or to put new legislation in place. So it will go back to the pre-2017 numbers.
Okay. So I guess point being, if you have a net worth that exceeds $10 million, $12 million, and it doesn't look like that act is going to get extended sometime in 2025, maybe the second half of 2025, you might want to look to do some significant estate planning to preserve that $13 million exemption you and your spouse have, so it doesn't get cut to what, $5.5 million?
It'll probably be somewhere around $7 million because again, it's indexed for inflation, so it's still going to go up some from where it was back in 2017, but yeah, and I guess on behalf of all tax advisors, both attorneys and CPAs, don't wait until the very end of 2025 to do that, because there's probably going to be a lot of other people trying to do that at the exact same time. So be proactive in terms of doing that. But you know, the good thing about it is we do have this increased unified credit amount right now, and the IRS has already come out with some guidance that says that if you go ahead during your lifetime and use, let's just go to next year's numbers and say $13.6 million. You know, my wife and I, we've got an estate of over $26 million. We go ahead and use all of our credit now, and then it goes back down at the end of 2025. The IRS has said that they won't claw that amount back, so you're not going to have to pay a gift tax at that point because you've exceeded what the then enacted unified credit amount is. So again, it's kind of a use it or lose it proposition as we approach 2025. Now, going back to the portability discussion from earlier, is if you are trying to make that decision about portability, we now have a 5-year period in which to file that return to elect portability. So we're in a kind of this sweet spot right now where there is this overlap between when the law may change, so that if someone has died recently and you're trying to make a decision about filing that portability return, you do have some time to wait and see. But what we always counsel people to do is that, to the extent that you think you might file a portability return, go ahead and collect all of your bank statements and any appraisals, any type of information that we might have to use to file that 706, go ahead and get it done now, so that you're not, 4 or 5 years from now trying to go back and say, okay, what was the date of death value of all of these assets? Because when you do file a portability return, you have to file it the same way that you would if you had a taxable estate, meaning that you've got to disclose all of your assets and you've got to have backup for all that information that's on the return. So
I gotcha. Okay, and then last thing I wanted to hit on before we wrap up, step up in basis. So how does that work, and how can you use it to your advantage, either if you want to leave money to a surviving spouse or if you want to leave money to children down the road? Sure.
Yeah, and so the way the step up in basis works is that if you own an asset at the date of your death, and let's say, going back to your example earlier, you paid $100,000 for a piece of property, and now it's appreciated to where it's worth $200,000. If you're holding that property still at your death, your beneficiaries are going to take a fair market value basis as of the date of your death. So in this example, $200,000, meaning that if they turned around and sold it immediately, there would be no capital gains tax like we were talking about earlier. It would just be, you'd be selling it for what it was worth, and your basis is equal to what it is worth. Conversely, if you make a transfer during your life, going back to our gifting conversation, if I'm to gift property to a child of mine or someone else, or I'm going to put it in trust for their benefit, you've got a carryover basis in that instance. So rather than the cost basis that most people are used to, where if I buy a house and I'm paying $100,000 for it, my basis is $100,000. If I don't pay anything for it and somebody has just gifted it to me, it's just going to be whatever the basis was in the hands of that individual that's gifting it. So again, even though we've got this unified credit that covers both lifetime and death transfers, the way we handle basis in those situations is different. And so again, if you've got appreciated assets, because people come to us all the time and say, well, Mom, she's lived in this house and she doesn't really need to stay there anymore, and we're thinking about selling it, but she's in really bad shape, so we're going to move her to a skilled nursing facility or something like that, so we want to go ahead and sell it. And, my advice sometimes is, depending upon the amount of the appreciation, and if you're not needing those funds to pay for her care, that it may be best to wait and wait until after she passes and then sell it, because you've gotten that step up in basis and you've reduced the overall tax burden so that there's more that goes to the beneficiaries in that example. So again, that's, and particularly as we approach the end of 2025, and if you're talking about making transfers to use up your unified credit before it goes back down, you want to be cognizant of whether you're transferring low basis or high basis assets, because if you're funding all these trusts with low basis assets, you're not going to be able to take advantage of that step up in basis potentially in the future.
Because the recipient of that gift is assuming your basis, it's not getting stepped up.
That's correct.
I got you. So a lot of potential planning needs the second half or at some point during 2025, sure, depending on what it looks like the estate tax is going to do.
Right.
So guys, that was awesome. Thank you, Chris. Thank you, Alexander. Thank you, Kim. Kim, anything you want to add? Why do people why does my CPA charge so much for my tax return? Can you answer that question? No, I'm kidding.
Well, okay. let's have a conversation about the shortage of CPAs right now.
Very true. Very true. Very true. Guys, that was awesome.
Supply and
Thank you.
demand.
Absolutely. Absolutely. Thank you, guys.
The information provided here is taken from sources which we believe to be reliable, but the accuracy and completeness of such information is not guaranteed by us. This is not an offer to sell or a solicitation of an offer to buy any securities. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Employees of Janney Montgomery Scott, LLC, or its affiliates may at times release written or oral commentary, technical analysis, or trading strategies that differ from the opinions expressed here. Investing may involve market risk, including possible loss of principal. Janney Montgomery Scott, LLC, its affiliates, and its employees are not in the business of providing tax, regulatory, accounting, or legal advice. Any tax-related statements are not intended for and cannot be used or relied upon by any such taxpayer for the purpose of avoiding tax penalties. Any such taxpayer should seek advice based on the taxpayer's particular circumstances from an independent tax advisor. For more information about Janney, please see Janney's Relationship Summary, Form CRS, on www.janney.com/CRS, which details all material facts about the scope and terms of our relationship with you and any potential conflicts of interest.